Hey everyone, and welcome back. Today we're diving into the world of Vanguard ETFs.
Specifically.
Yeah, specifically the ones that are focused on dividends.
Nice.
So our mission today is to really help you guys navigate all this and, maybe find a hidden gem or two you can add to your portfolio.
Love it.
We found this really interesting article that highlights 3 Vanguard ETFs that have had crazy good performance this year.
Yeah, in 2024.
And yeah, Vanguard in general, one of the things that always draws people to them is that they have super low expense ratios.
Oh, yeah, absolutely. Their expense ratios are fantastic.
Yeah.
They range from like a tiny 0.03% all the way up to, still very reasonable 0.22%.
Right.
So those low fees, and it can make a big difference in your returns over time.
Absolutely. And, they've got tons of dividend-focused ETFs that are really great.
Right.
But, not all of them have performed the same this year.
Well, that's true. And that's what we're here to kind of break down and, look into today.
Exactly. Yeah.
Right.
So let's jump right in. Okay. The first 2 ETFs on our list are the Vanguard Energy ETF, that's VDE, and the Vanguard Utilities ETF, that's VPU.
Okay.
Both of those are actually boasting some pretty impressive yields right now.
For sure.
3.3% for VDE
Wow.
and 2.9% for VPU. And on top of that, they both have the same low expense ratio, which is only 0.1%.
Yeah, that's great. But there's something else that's interesting about both of these ETFs.
Oh, what's that?
They're what we call top heavy.
Top heavy. Okay.
Yeah. So that basically means that a big chunk of their holdings are concentrated in just a few companies.
Okay. How top heavy are we talking here?
So with VDE, about 50% of its portfolio is only invested in 5 big players in the oil and gas sector.
Wow.
So those are ExxonMobil, Chevron, ConocoPhillips, EOG Resources, and Williams.
Okay.
And then for VPU, it has like 36.5% of its assets in the top holdings. And a huge 63% is just focused on electric utilities.
So that sounds like putting a lot of your eggs in one basket.
Yeah.
Isn't that kind of risky?
Well, it can be a concern for sure. But in this case, for like VDE and the energy sector, that concentration, it can actually be an advantage.
Oh, really? How so?
Companies like ExxonMobil and Chevron, they're really known for being stable and resilient.
Yeah, they're pretty solid company.
Yeah. So like ExxonMobil, for example, they have a track record of 42 years of dividend increases in a row.
Wow, 42 years.
It's amazing. And Chevron has 37.
Okay.
And, they both have really strong balance sheets, which is super important in that industry because it needs a lot of capital investment.
So I guess with VDE, it's almost like you're betting on these big energy giants.
Yeah, exactly.
Okay.
Now, if we switch over to VPU and the utilities sector,
Okay.
that ETF approach gives you a different benefit, and
Yeah.
that's geographic diversification.
Okay.
So if you invest in a group of utilities that are spread across different regions, it helps to lower the risk that if something happens in one region, it'll affect your whole investment.
Oh, that makes sense.
Yeah, so like, say, a natural disaster or something.
Yeah.
So it's like a safety net in a way.
I like it.
Yeah, so if you take Nextera Energy, for example, that's VPU's largest holding. Their main company, Florida Power and Light,
Yeah.
they're the biggest electric utility in the U.S.,
Wow.
but they're mostly in Florida, right?
Yeah.
And then you got Southern Company, which is the second largest holding in VPU,
Okay.
and they're mainly in the southeastern U.S.
Gotcha.
So when you combine those
Yeah.
and other utilities in the ETF,
Yeah.
it spreads the risk out geographically.
That makes sense.
Yeah,
So VDE is kind of like concentrated stability and energy,
exactly.
and VPU is geographic diversification in utilities.
You got it.
Okay, cool. So both of those sound like good options if you want to invest in a specific sector.
Right.
But now I think it's time to move on to the star of the show,
Right.
which is the Vanguard High Dividend Yield ETF.
VYM.
VYM, that's the one.
This one's a good one.
It is a good one. So it has a 2.8% yield,
Okay.
which is similar to VDE and VPU,
Right.
but it has an even lower expense ratio.
Oh, wow.
Only 0.06%.
That's awesome.
So that's pretty nice.
That's really good.
But what really makes VYM stand out
Okay.
is its diversification.
Okay, like it.
Yeah. So unlike VDE and VPU,
Right.
VYM invests across a wider range of sectors,
Yeah.
and it's also not as top-heavy.
Oh, interesting.
Yeah, only 15.4% of its assets are in its top 5 holdings.
Okay, that makes sense.
And those top holdings include some pretty familiar names.
Yeah. Ooh.
You've got Broadcom, JP Morgan Chase, ExxonMobil, Home Depot, and Procter & Gamble.
Those are some good, solid companies.
They are solid companies, but here's something I thought was interesting.
Okay.
While VYM does include these well-known blue-chip companies, some of them, like Walmart, they're not really known for their high yields.
Right.
Walmart's yield is only around 1% right now.
Okay.
Even though their stock has gone up like 72% this year.
Wow.
So how does a company with such a low yield fit into an ETF that's supposed to be about high dividends?
That's a great question, and it really shows how VYM's strategy works. So they balance those low-yield, high-growth companies with other companies that are more established.
Okay.
They might not be growing as fast, but they offer higher yields.
So it's like trying to find that balance between growth and income.
Exactly.
Okay.
It's all about finding that sweet spot.
Oh, like it.
So like Johnson & Johnson, for example, or J&J.
Okay.
It has about the same weighting in the fund as Walmart, but it has a much higher yield of 3.2%.
Okay.
And it has a lower valuation.
Oh, wow.
So when you hold both of those stocks, investors can get both growth potential and a steady stream of income.
So it's like getting the best of both worlds.
Exactly.
Okay, cool. And then there's another interesting thing to think about.
What's that?
VYM's yield is actually better than some of the other well-known value ETFs from Vanguard.
Really? Like which ones?
So for example, the Vanguard Value ETF and the Vanguard Mega Cap Value ETF, those both yield 2.3%.
Okay.
And then the Vanguard Dividend Appreciation ETF, that one only yields 1.8%. So VYM's 2.8% yield really puts it ahead of the pack.
Yeah, that's a big difference.
It is. So if yield is what you're looking for, VYM is definitely looking good.
For sure.
But of course, yield is only part of the story.
Right.
We also need to talk about performance.
Oh, yeah. How's it been doing?
Let's just say VYM has been on a roll.
Okay, give me the numbers.
So year to date, it's up an impressive 20%.
Wow, that's great.
Over the past 5 years, it's returned a remarkable 46.4%.
Really?
And over the last decade, the returns have been truly outstanding.
All right, I'm ready.
91.1%.
Wow, that's amazing.
Yeah, and remember, these numbers don't even include the dividend payouts yet.
So how much are we talking about when you add in the dividends?
Well, when you add those in, VYM's total return over the past decade jumps to an incredible 162%.
That's insane.
That's the power of compounding.
Wow.
So we've covered a lot here.
Yeah.
We started with VDE and VPU, which are those two sector-specific ETFs.
Right.
They offer attractive yields and their own unique advantages. And then we moved on to VYM, which is more diversified.
Yeah.
And it balances value and income really well.
Right.
And it's also delivered some pretty impressive returns.
It has.
But I think we should break this down a little bit more.
Okay.
And talk about why VYM's performance is so much better than other value-focused ETFs.
Yeah, that's a good question, and one that we'll dig into in the next part of our deep dive.
Yes, stay tuned, folks, because we're just getting started. Welcome back, everyone.
All right.
We just went over the Vanguard High Dividend Yield ETF.
VYM.
VYM. Yeah, it seems to be doing really well.
It is.
But I'm curious what's driving that performance. I mean, what makes it better than other value ETFs?
Yeah, that's the big question.
Yeah.
Well, VYM's success is really because of a few things.
Okay.
It has a really carefully planned investment strategy, and it also tracks a really good underlying index.
Okay, so you mentioned before that VYM isn't as top-heavy as some of those other ETFs.
Right.
So what does that mean for managing risks?
So think of it like this. If an ETF has most of its investments in just a few companies, then it's really dependent on how those few companies do. So if one of them starts doing bad, it can bring the whole ETF down with it.
Right.
But with VYM, since it's more diversified, the risk is spread out more evenly.
Yeah, okay.
So it's less likely that one company's bad performance will hurt the whole portfolio.
So even if one company has like a bad quarter, it's not going to like sink the whole ship.
Exactly. That's what diversification is all about.
Yeah.
It helps you handle those unexpected things that always come up in the market.
That makes sense.
Yeah.
But how does VYM pick which companies to invest in?
Oh, so VYM,
Yeah.
it tracks this thing called the FTSE High Dividend Yield Index.
Okay.
And this index is designed to include stocks that have a good history of paying higher than average dividends.
Okay.
But it's not just about chasing yield.
Right.
The index also looks at things like market capitalization, which is basically the size of a company, and liquidity, which is how easy it is to buy or sell a stock.
So they're looking for companies that are paying good dividends, but they also want to make sure those companies are doing well financially.
Yeah, exactly.
Oh.
And that their stock is easy to trade.
Makes sense.
Yeah. So the goal is to build a portfolio that's good for income.
Yeah.
And can handle any bumps in the road.
Okay.
That's a big part of why so many investors like VYM.
So VYM does all the hard work of picking good dividend-paying companies.
Yeah, it does a lot of the work for you.
But let's be real. I mean, every investment has some risk, right?
Oh, absolutely.
So what are the risks with VYM?
That's a really important question.
Yeah.
VYM is well diversified, but it's still mostly invested in stocks.
Okay.
And, stocks can be volatile. Their value can go up and down a lot, especially in the short term.
So if you need your money fast,
yeah,
VYM might not be the best option.
You're right. It's probably not the best choice if you need quick access to your cash. VYM is really better for those long-term goals.
Right.
Where you have time to wait out those ups and downs in the market.
That makes sense.
Yeah.
So let's say someone's okay with the ups and downs of the stock market, and they're really looking for that passive income. How does VYM compare to other ETFs?
So as we've talked about, VYM's yield is really good, especially compared to other Vanguard value ETFs.
Okay.
And VYM also has a great history of consistently paying dividends.
So that's really important for those income investors.
Yeah, they can rely on those payments.
So it sounds like investors can feel good about getting a regular income from VYM.
I mean, you can never be 100% sure about the future.
Right.
But VYM's history of payouts shows that it's really good at generating income.
So far, VYM seems to have a lot going for it.
It does.
It's diversified. It's got a good track record, a competitive yield, and a smart way of picking companies.
I agree. It sounds good.
Are there any downsides investors should know about?
That's a good point.
Yeah.
VYM does have a lot of strengths.
Yeah.
But no investment is perfect.
Right.
So because VYM focuses on dividend-paying companies, its growth potential might not be as high as the whole market.
Okay.
Especially when the market is growing really fast. That's when growth stocks tend to do better.
So it's like a trade-off. You get current income, but you might miss out on some future growth.
Exactly. It's all about finding the right balance for you.
Right.
What are your goals?
Yeah.
How much risk are you willing to take?
Okay, so we've talked about diversification, risk, income potential, and potential trade-offs.
A lot to think about.
It is. I think the big question everyone wants to know now is
VYM the right choice for me?
That is the $1 million question.
It is.
And that's exactly what we're going to talk about in the last part of our deep dive.
All right, looking forward to it.
Yeah, we'll look at the pros and cons. We'll consider different types of investors. Okay. And we'll help you decide if VYM should be in your portfolio. All right, so we've really dug into the Vanguard High Dividend Yield ETF VYM.
We have.
The big question is it right for you?
Yeah, does it fit your investment goals?
Right, so let's say you're getting close to retirement.
Okay.
And you're looking for some reliable income to add to your savings. Could VYM be a good option?
It could be.
Yeah.
It's got that history of paying dividends consistently.
Yeah.
And it's relatively low risk. So it could be really appealing for retirees who want that passive income without worrying too much about the market going up and down.
Yeah, because in retirement, you really want to protect what you've saved.
Exactly.
And have that steady income coming in.
For sure.
But let's think about a younger investor now.
Okay. Someone who's just starting out.
Yeah, someone with more time.
Right.
Would VYM still be a good choice for them?
Well, younger investors, they usually are okay with taking more risk.
Yeah, they're more focused on growth.
Exactly. So in that case, VYM might not be the main part of their portfolio.
Okay.
They might want to put more money into ETFs that are focused on growth or even individual stocks.
Right, even if those don't pay dividends.
Right, because they have more time to recover if they lose money.
Yeah.
And they can really benefit from compounding over the long term.
So it's all about finding that right mix of growth and income.
Yeah, you have to think about how much time you have.
Yeah.
And how much risk you're comfortable with.
Right, because there's no one right way to invest.
Absolutely.
Everyone's different.
Okay, so to sum up what we've learned about VYM.
Okay.
If you're looking for an ETF that's diversified and low cost and has a good track record of paying dividends, then VYM is definitely worth checking out.
I agree.
It's especially good for investors who want that reliable passive income.
Right.
Like people who are nearing retirement.
Yeah.
Or people who just don't want to take on a lot of risk.
Makes sense.
But if you're younger and you're really focused on growth,
you might want to put less money in VYM or look at other investments that are more growth focused.
That fit your goals better.
Exactly.
Yeah.
So the bottom line is there's no right or wrong answer about VYM.
Right. It depends.
You need to know your financial goals, how much risk you're willing to take,
Yeah.
and then pick investments that match those things.
It's all about making it work for you.
Right, and remember, those things can change over time.
Oh, for sure.
As you go through life.
Yeah, life happens.
Exactly. So it's always good to take a look at your portfolio.
Right.
And see if you need to make any changes.
Keep it updated.
Exactly. Well, that brings us to the end of our deep dive into VYM.
It's been a good one.
I hope you guys have a much better understanding of this ETF now.
Me too. It's a popular one.
It is. And if you're still not sure if VYM is right for you,
Yeah.
do some more research. Maybe talk to a financial advisor.
It's always a good idea.
And the most important thing,
What's that?
only invest in what you understand.
Yes, and what you feel good about.
Absolutely. Well, we'll leave you with this.
Okay.
The market is near all-time highs.
It is.
So could VYM, with its focus on value and income, be a safe place for investors who don't want to take on a lot of risk?
Something to think about.
It is. Let us know what you think, and until next time, happy investing.